The recent economic turbulence has injected new uncertainty for anyone trying to make a real estate investment decision. There's no expert consensus on whether we're in a housing correction now or even whether we'll go into one anytime soon. But if the market slows, it's worth considering whether you should revisit strategies that might have depended on runaway growth. Today we're going to talk about housing corrections and how they affect your investments. Before we get started, I want to remind you that I'm not a financial advisor and this is not personalized advice. But there's no question that rising interest rates and other economic factors have affected the housing market recently. Even Fed Chairman Jerome Powell has suggested that housing may be in for a correction sometime soon. Longer term, what we need is supply and demand to get better aligned so housing prices go up at a reasonable level, at a reasonable pace, and people can afford houses again. We probably in the housing market have to go through a correction to get back to that place. Powell said this in late 22 at a news conference after the Fed approved one of the many rate hikes in recent months. There are few signs to date that the housing market has had any kind of slowdown that is severe enough to be referred to as a correction. For reference, in the stock market, a correction is a drop of 10% off of a recent high. Housing prices have not done that during the current economic cycle. It remains really unclear whether there's going to be a housing correction in coming months. In any case, a change in market conditions is a great prompt to think about your investment strategy and make sure you're comfortable with what you're doing. Let's talk about some of the ways you can do that. For starters, diversify your portfolio. You probably hear me talk about this in every video I make. Diversifying your investments is a good idea because it protects you against the failure or the decline of any particular investment because of some specific factor that relates only to that investment. So when you're diversifying your real estate portfolio, you can think about maybe buying different types of real estate. Maybe housing and commercial real estate will perform differently in the current economic climate. Maybe they won't, but you then have exposure to those different parts. Or, if you pay attention to the real estate market, it is almost always true that prices are going up and down at different rates in different parts of the country. Maybe people are moving from one area where the population is declining to a place where the population is growing and housing demand is higher. So you may want to consider places that have different population and demographic profiles. Beyond that, you also can consider diversifying beyond real estate. Diversifying doesn't relate just to assets themselves, but to asset classes. Maybe you want to consider stocks, bonds, etc., and other things that may be able to help you deal with any kinds of issues that the housing market faces specifically. Here's another idea. Consider real estate funds. So real estate is hard to buy in a diversified portfolio unless you have a lot of money. It's hard to buy lots of different houses in lots of different parts of the country. Can you imagine flying around looking at a house in California, Florida, and Illinois? Not everyone has the resources to do that. Some people do, but not everyone does. And if you're not one of the people that does, or if you just want a simpler way to diversify your housing portfolio, one thing you can consider is a real estate investment trust. These are usually called REITs, and what they are is managed portfolios of real estate. Basically, someone else buys a lot of different types of real estate and then sells shares in the business that they made that manages that real estate. So how do you do that? There's a lot of ways. There are mutual funds, there are other ways, but one of the main ways to do this is by looking directly on the stock market. Some REITs are actually publicly traded, so you can just buy a share of them on the stock market in the way that you would buy a share of any other company. Another thing to consider is that your investment might be for a longer term than any kind of housing correction might last. So yeah, we've all thought about the idea of buying a property, throwing a new coat of paint on it, and selling it in a few months for a profit. That's called flipping. We've all heard about it. We've seen TV shows about it. It sounds attractive and, it can work out, but even in a hot market, it doesn't always. In a colder market, the challenge is even greater. You'd have to increase the value quite a bit, to get a profit when prices are not doing what they used to. So you could think about, if you wanted to invest in a piece of real estate, hanging on to it for longer, maybe renting it for a while until you feel that the prices have recovered to the point where you can get the kind of return you want. And, there's no guarantee that any particular investment is ever going to work out for you. But if you think for the longer term, you might be able to ride out a dip in prices, or you could even get a lower initial price based on, buying at the right time during a correction. So renting for long term is just one way that you can look at adding some kind of income to properties that you may not be ready to sell because you're not happy with the current market conditions. For instance, there's always short-term rentals such as Airbnb. You might be able to get away for the weekend if you live in a place where people want to come stay. That can provide some income for you potentially. You could consider renting out an outbuilding if your local government allows that, or you consider moving into, say, an in-law apartment and renting out the main house. Depending on where you live, there are lots of options for what you might be able to do to create some income that can help you ride out any kind of correction. You can always rent property out, obviously, even if there isn't a housing correction. But I think we should remember here that pretty much everything we talked about today is available to you whether there's a housing correction or not. And a correction is an important term and a distinction to make, but economists are going to figure that out. We know the housing market is changing, and it's a good time to think about whether we're prepared for a downturn. A downturn can happen anytime. Whether there's one now or not, having a plan is a good idea, and situations like these are always a good time to think about whether you are prepared. So, while we wait around for economists to make that decision, you can think about whether any of these strategies would work for you to stretch your real estate dollars further. I'm Andy Rosen, an investing writer for NerdWallet. If you want the latest on what's going on with the housing market, please check out our site and read some of our articles. And if you learned something today, don't forget to like and subscribe.